Good morning. Europe starts the week with a very different filter from Friday. Oil is falling, futures are firmer, but the reason for the relief matters as much as the relief itself. The question for private investors is not whether this is good news or bad news. The question is whether the market is about to confuse a ceasefire-style oil move with a clean growth signal. Start with oil. Financial Times, CNBC, MarketWatch, and Investing.com all point to the same shift. Brent fell more than 4% after the United States and Iran paused attacks, and Iran signaled it would halt strikes as long as the U.S. pause holds. Yahoo market data put Brent near $92 before Europe opened, down more than 4% from the previous close. For Europe, that changes the map immediately. The cleaner side is airlines, chemicals, and other margin-sensitive consumers of energy if the move holds. The pressure side is the producer basket, where Shell, Total Energies, and BP have to prove that the oil risk premium was not the whole story. For private investors, the takeaway is to separate relief from durability. A lower oil price can ease inflation fear and input costs, but it can reverse quickly if shipping, the Red Sea, or the Strait of Hormuz become stressed again. Second, the AI trade is not cooling down. It is changing form. CNBC, FT, BBC, and Investing.com reported that Chinese memory chip maker CXMT surged roughly 500% in its Shanghai debut. Investing.com also reported Nvidia's $1 billion plan in South Korea's Naver, and a separate report that Nvidia was in talks around a very large OpenAI data center guarantee. That matters for Europe because investors are being pushed from simple AI labels toward the plumbing of the build-out. Chips, power, data centers, automation, and financing. ASML, Infineon, and Schneider Electric are the cleaner European confirmation names to watch. The pressure is on any AI-adjacent story that cannot show orders, margins, or funding discipline. For private investors, the takeaway is proof over excitement. A spectacular China chip debut can lift the mood, but Europe still needs earnings evidence from its own supply chain. Third, China demand is no longer just a macro headline. CNBC, FT, and Investing.com all flagged slower Chinese industrial profit growth, with exports cushioning an uneven recovery. That is directly relevant to Europe's exporters, luxury goods, autos, and industrial cyclicals. The cleaner side is companies with pricing power and less dependence on a single China demand story. The pressure side is Volkswagen, BMW, and LVMH if investors decide that lower oil alone does not fix in-demand uncertainty. For private investors, this is the discipline point. A risk-on morning can still leave China's sensitive revenue exposed. The underappreciated story is bank capital. The Financial Times reported that UK lenders accused the Bank of England of ignoring Wall Street's capital edge, while another FT item said the Bank of England is expected to hold rates despite the oil price shock. This is not the loudest headline, but it can change how investors read European banks. Potential winners are banks with strong capital, fee income, and disciplined credit books. Pressure sits with lenders that need faster balance sheet growth or face tougher capital comparisons against U.S. peers. Barclays, HSBC, and Lloyds are the names to keep on the screen for the UK read-through. For private investors, the takeaway is that bank strength is not just about rates. Regulation, capital rules, and credit quality can matter as much as the yield curve. Here is the stock-led watch list. For oil relief, watch Ryanair, IAG, and BASF to see whether lower fuel and input costs translate into margin confidence. For energy pressure, watch Shell, Total Energies, and BP to see whether producers lag or prove resilience. For AI infrastructure, watch ASML, Infineon, and Schneider Electric for confirmation from orders, power demand, and capital spending. For China sensitivity, watch Volkswagen, BMW, and LVMH for demand and pricing power. For bank capital, watch Barclays, HSBC, and Lloyds for the gap between rate support and regulatory pressure. Market bias, cautiously constructive, but not broad. Lower oil and firmer U.S. futures give Europe a better opening tone. The risk is that investors overpay for relief before checking whether AI financing, China demand, and bank capital confirm the move. The mistake to avoid is treating every falling oil price as automatic risk-on. Today is a confirmation day. Margins, breadth, financing quality, and China exposure matter more than the index headline. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice. It is not a recommendation to buy, sell, or hold any security, and it does not include price targets, stop losses, position sizing, or personal financial advice.